Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Oklo.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So imagine spending like $100 billion to build the world's most advanced artificial intelligence supercomputer. You've got the best engineers, cutting-edge chips, the perfect software architecture.
The absolute best of everything.
Exactly. But then you go to flip the switch and nothing happens. Why? Because that massive new digital brain requires more electricity than a small European country.
Right, and the local power grid simply cannot support it.
It's literally the nightmare keeping tech executives awake at night right now.
It really is the defining bottleneck of this entire AI boom. I mean, when you ask a large language model a complex question, the computational effort is exponentially higher than a simple internet search.
Oh, absolutely. It's not even close.
Right, so we're moving into this era where data centers demand power on a gigawatt scale. And the traditional grid has suffered from, decades of underinvestment.
Yeah, it's completely unequipped for these massive spikes in localized demand. It's kind of like trying to fill an Olympic swimming pool through a garden hose.
That's a perfect analogy. The infrastructure just isn't there.
Yeah.
And that is exactly why we are seeing the ticker for Oklo absolutely everywhere lately. They are attempting to bypass the grid entirely.
But to get what they're doing, you kind of have to throw out your old assumptions about nuclear power. Right?
Definitely. I mean, most people picture these $10 billion sprawling concrete facilities that take 15 years to build.
With massive cost overruns.
Exactly. Oklo is doing something completely different with advanced modular nuclear reactors.
Think of legacy plants like the huge bespoke mainframe computers of the 1970s. Oklo is trying to build the modern, scalable server rack equivalent.
Manufacturing smaller, standardized powerhouses in a factory, and then just deploying them right where the energy is needed,
Wow.
like right next door to a massive data center.
All right, let's move into the wealth building context.
For anyone looking at their portfolio construction, it is critical to frame the timeline here. This is not some quick day trade.
Definitely not.
It's an asymmetric growth opportunity with a multi-year horizon. If you're structuring for long-term portfolio growth, you're essentially looking at a foundational play on the massive shift toward localized, carbon-free, baseload energy.
And that word baseload is really the absolute linchpin of this entire thesis.
Absolutely.
Like solar panels and wind turbines are fantastic technologies, but they suffer from intermittency. You simply cannot run a billion-dollar AI training model on intermittent power.
Right, because if a data center loses power for even a fraction of a second, it can corrupt massive data sets. It costs millions.
Exactly. They need 247 uninterrupted, predictable energy. That's baseload power.
And historically, you only got that from burning coal or natural gas. But major tech companies have these aggressive, publicly stated net zero carbon pledges.
So they can't just build new coal plants.
No, they really can't. Nuclear is currently the only commercially viable technology providing zero carbon baseload power.
Which means investors really need patience here. The psychology of holding a pre-revenue technology stock is totally different from holding, say, a mature dividend-paying consumer goods company.
You have to be comfortable sitting through heavy, capital-intensive development cycles.
Yeah, you're buying the architecture of tomorrow. You have to endure engineering and regulatory milestones before you ever see traditional top-line revenue.
Now let's look at the fundamentals.
This is where we need to strip away the hype and look at the cold, hard math of the balance sheet. Oklo has zero commercial revenue right now.
Right. Absolutely zero.
And because of the massive capital required for nuclear engineering, they are operating with deeply negative free cash flow.
It sounds terrifying on the surface.
It does, but we have to look at how they're capitalized. Following their SPAC merger in May of 2024, they secured a war chest of over $300 million in cash.
And that SPAC structure was vital. It let them bypass the traditional, lengthy IPO roadshow and secure a massive influx of capital in one sweeping motion.
Giving them a multi-year operational runway, and crucially, doing it with minimal traditional debt hanging over their heads.
Which is huge for surviving until commercialization.
Okay, but I have to challenge the premise here. Let's look at this purely from a valuation standpoint. You have a company with zero revenue, burning cash, no buybacks, no dividends.
I know where you're going with this.
How can a purely pre-revenue entity justify the multi-billion-dollar market capitalization we are seeing? It honestly feels incredibly speculative.
It does, until you understand the underlying mechanics of their recent partnership with the U.S. Department of Energy. This was the fundamental aha moment for the company.
The surplus plutonium utilization program.
Exactly. Being selected for that program entirely shifts how you value their future margins.
Let's explain what that actually means, because it sounds like bureaucratic jargon.
It's practically alchemy, honestly. Traditional reactors use water to slow down neutrons, but Oklo developed proprietary fast reactor technology that doesn't slow the neutrons down.
Meaning they can actually utilize spent nuclear fuel.
Yes, what most people call nuclear waste. By partnering with the DOE, the government is essentially giving Oklo exclusive, subsidized access to the hardest-to-get fuel on Earth.
Just because Oklo is agreeing to recycle the government's toxic waste, that's wild.
It really is. So instead of the government paying billions to bury this waste in a mountain somewhere, they are handing it over to power AI.
And the specific fuel we're talking about is H8LEU, right? High-assay, low-enriched uranium.
Exactly. And for anyone studying the sector, HALEU is the massive, glaring bottleneck. Historically, the vast majority of commercial enrichment capacity has been located in Russia.
Which is obviously a total non-starter for U.S. national security and domestic energy infrastructure today.
Right. Every other advanced nuclear competitor is scrambling, trying to figure out how to physically fuel their reactors without relying on hostile foreign supply chains.
Oklo effectively just stepped around that entire global supply chain nightmare. By securing this domestic recycled material from the DOE, they have structurally solved their biggest future cost center.
Exactly. In financial modeling, fuel procurement introduces huge margin risk. When the government effectively de-risks your primary raw material, the market violently recalculates your future profitability.
That brings us to the catalyst timeline.
Since the fundamental game just changed, we have to track the milestones that will prove this business model works over the next several months.
And the biggest immediate speculative catalysts are unannounced power purchase agreements, or PTAs, right?
Let's unpack the mechanics of a PPA, because it's the lifeblood of infrastructure development. A PPA is a long-term contract where a massive consumer, say Amazon or Microsoft, agrees to buy power at a fixed price for 10 or 20 years.
And crucially, they agree to this before the power plant is even fully built.
Right. Once a developer has a signed PPA, the project becomes bankable. You can take that contract to a major bank and secure the debt financing to construct the facility, because the future cash flow is legally guaranteed.
That is why the market is laser-focused on hyperscalers. The companies building the data centers are desperate for on-site power.
If Oklo announces a finalized PPA with a major tech giant, it serves as the ultimate commercial validation. It proves the smartest tech companies in the world have looked at the engineering and decided it's viable.
Moving further out on the timeline, let's look ahead to their August 2026 earnings report. Earnings season for a pre-revenue company is unique.
Yeah, metrics like earnings per share are completely meaningless here.
Exactly. Instead, the focus shifts entirely to the balance sheet burn rate. You want to see exactly how fast they are chewing through that $300 million cash pile.
Alongside the burn rate, the critical updates will revolve around the NRC, the Nuclear Regulatory Commission. Oklo is navigating the licensing process for their very first commercial Aurora powerhouse at the Idaho National Laboratory.
Every single piece of correspondence with the NRC is a potential catalyst. We also have to watch for the finalization of the binding financial terms for that DOE plutonium contract.
Right. Being selected for the program was a massive win, but getting the legally binding financial framework locked in is the necessary next step.
Now let's pivot to the chart.
When you pull up the price action, it provides a masterclass in how fundamentals drive technical structures. We recently saw a massive upside gap, followed by a complete structural breakout from prior consolidation.
Yeah, the price didn't just drift higher, it exploded through previous resistance ceilings. And this wasn't random noise or some speculative retail short squeeze.
No, it was driven entirely by that DOE fundamental de-risking event.
Technical resistance levels are formed by the market's collective assumptions about a company's risks. When the DOE fundamentally de-risked the future fuel supply, all those previous assumptions became obsolete.
A fundamental paradigm shift always invalidates old technical resistance. The chart violently reacted to price in a new, de-risked reality.
And look at the aggressive momentum and institutional flow. After the initial surge, we saw a standard post-earnings pullback, but it was immediately met with latent demand.
That concept of latent demand is key. When a stock dips and buyers instantly step in to absorb the selling pressure, it means large institutions are actively building positions.
They aren't chasing the stock when it spikes, they're waiting for discounts. When major funds view a 5% drop as a buying opportunity, it creates a floor under the price. It's a classic hallmark of a high-conviction uptrend.
So what does market sentiment look like?
Wait, I should say the transition. So what does market sentiment look like?
The quantitative mood across Wall Street is overwhelmingly bullish. We are seeing major financial institutions aggressively adjust their models.
Goldman Sachs recently bumped their target from $63 to $66, right?
Yes, but the target that really caught the market's attention came from Wedbush. Dan Ives reiterated an outperform rating with a massive $110 price target.
Let's break down the mechanics of a $110 target on a pre-revenue company. To get a number that high, they have to be mathematically modeling a blue sky scenario.
A future where Oklo doesn't just build one reactor, but successfully lands fleet-wide PPAs with multiple hyperscalers.
Effectively becoming the dominant captive power provider for the AI revolution, it requires perfect execution.
It does. But the market is heavily weighing the institutional backing to justify that confidence. And that conversation starts with Sam Altman, the chairman of Oklo.
Having Altman in that seat is not just a vanity metric. He is arguably at the absolute epicenter of the global AI boom.
His involvement serves as a highly credible bridge between the AI industry's desperate need for power and Oklo's engineering. When negotiating a PPA, having the preeminent figure in AI in the room completely changes the dynamic.
Beyond individual backing, there is a massive macroeconomic tailwind pushing the entire sector, too.
Oh, definitely. Just look at fund flows into the VanEck uranium and nuclear ETF. Billions of dollars of institutional capital are sloshing into the space.
The broader market has finally connected the dots. You simply cannot have the AI revolution without a simultaneous nuclear energy revolution.
Now let's talk about the risks.
Because if you are listening to a $110 price target and assuming it's a guaranteed path to wealth, you are ignoring the sheer complexity of nuclear engineering. Let's build out the bear case.
Starting with valuation risk, I assume.
Exactly. The stock is trading at an incredibly rich premium based entirely on future projections. That means it is priced for absolutely flawless execution with zero margin for error.
If they miss a deadline, the penalty from the market will be severe.
That brings up multiple compression. If a hyperscaler decides to sign a PPA with a competitor instead, or if Oklo's deployment timeline gets pushed back by 2 years,
the fundamental thesis might survive, but the premium investors are willing to pay will just evaporate.
The stock price can collapse simply because the wait became too long, and that ties directly into the second major risk: severe execution and regulatory risk.
This is the critical friction point. The Nuclear Regulatory Commission was designed in the 20th century to regulate massive, light water-cooled legacy reactors.
But Oklo is trying to get them to license a liquid metal-cooled fast reactor utilizing HLEU fuel. The NRC has never licensed a commercial reactor of this specific type in its history.
They are dealing with totally new physics and safety models. While that is uncharted territory, you have to factor in the heavy mitigation provided by the DOE partnership.
How much does that actually mitigate the NRC, though?
Well, by partnering directly with the DOE on plutonium recycling, Oklo effectively weaponizes the federal government's own priorities to help push through the red tape. The government desperately wants this technology to succeed to solve their nuclear waste problem.
I am going to push back hard on that assumption. The Department of Energy and the Nuclear Regulatory Commission are completely separate entities.
That is a fair distinction.
Just because the DOE wants a commercial solution for nuclear waste does not mean the NRC, which is strictly mandated to focus on safety, is going to suddenly fast-track a totally novel reactor design.
Bureaucracy is still bureaucracy, right?
Exactly. If the NRC demands an extra 3 years of metallurgical testing on the reactor core materials, the DOE cannot overrule them. You are betting that a federal safety agency will suddenly move at the breakneck speed of Silicon Valley.
And history tells us that is a highly dangerous bet to make with your capital.
So with everything on the table, what's the final verdict?
Weighing the transformative potential against the undeniable regulatory hurdles, our analysis delivers a bullish score of 8.
Give us the summary of the thesis.
Oklo is currently the most compelling advanced nuclear contender, uniquely positioned to solve the massive AI power bottleneck. Their proprietary fast reactor technology provides a formidable competitive moat, heavily de-risked by their fuel supply agreement with the federal government.
Yes, it carries a premium valuation that requires near-perfect execution, but the pathway to commercialization is incredibly clear,
Making this a highly compelling asymmetric growth opportunity.
The final takeaway for you, the listener, is understanding your own target horizon. This is strictly a multi-year hold, requiring a minimum of 18 to 36 months of patience.
You are waiting for the deployment of the first commercial Aurora powerhouse in Idaho and the actual onset of utility-scale top-line revenue.
You are quite literally letting the architecture of tomorrow be built. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com/pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.